A woman in Ohio got a $12,000 raise. On paper, it was a win, a promotion, proof she was doing something right. 9 months later, she sat down to do her taxes and found something that didn't make sense. She had less money in her bank account than the year before the raise. Not because she spent more, not because she splurged. Her health insurance premium had tripled. Her childcare assistance disappeared. Her student loan payment jumped by $300 a month. The raise was real. The money behind it wasn't. And this isn't some rare accounting glitch. It happens to millions of people every single year, and almost nobody understands why, because nobody explains it to them. Everyone is taught the same simple equation: earn more, keep more. More income should always mean more freedom, more savings, more room to breathe. That's the assumption baked into how people think about their careers. Ask for the raise, take the promotion, pick up the extra shift. The math should always point in the same direction, up. But for a huge number of Americans, especially in that middle income range, $35,000 to $75,000 a year, that math quietly breaks. Somewhere in that range sits a set of invisible tripwires. Cross one and the government or your employer doesn't just tax your new income. They pull support out from under you at the exact same moment. The raise shows up, the safety net disappears, and most people don't even know it happened until the damage is already done. To understand why, you have to stop thinking about income as one number and start thinking about it as a stack of separate systems, each one watching your paycheck and reacting on its own timeline. Take a single mother earning $42,000 a year. At that income, she likely qualifies for a health insurance subsidy through the marketplace, worth several $1,000s annually. She may also qualify for a childcare subsidy that can be worth another few thousand. She's paying off student loans on an income-based plan, where her monthly payment is calculated as a percentage of what she earns. Now she gets a raise to $48,000, $6,000 more before taxes. Here's what actually happens. Her federal and state income taxes take a bite. Normal, expected, no surprise there. But at $48,000, she crosses the income line where her health insurance subsidy shrinks sharply. Her monthly premium jumps by $200. That's $2,400 a year gone. Her childcare subsidy is reassessed. Because her income is now too high, she loses a portion of it too. Another chunk taken directly out of the raise. Her student loan servicer recalculates her income-based payment. It goes up as well because the formula is built directly off her income. Add it up, and the $6,000 raise has been eaten alive, not by one system, but by 4 separate systems, none of which talk to each other, all reacting to the same number at the same time. Here's the part almost nobody sees coming. When you add up regular income tax plus every benefit she loses, her real effective tax rate on that raise isn't 20% or 30%. It's closer to 90%. In some documented cases, families have crossed thresholds where the combined loss of tax credits and benefits actually exceeds 100% of the raise. The government has a term for it, and economists call it an implicit marginal tax rate. And in the steepest cliffs, it can technically go past 100%, meaning someone can end up with less spendable income after a raise than before it. This isn't a conspiracy. Nobody designed it to punish people for succeeding. It's the accidental byproduct of dozens of separate assistance programs, each built with its own income cutoff, stacked on top of each other with zero coordination. Tax brackets are gradual and public. Everyone half understands them. Benefit cliffs are the opposite, sudden, invisible, and scattered across systems that never talk to each other. That combination is what makes this mechanism so dangerous. You don't see it coming because no single institution is responsible for warning you. Picture income like water filling a glass. Tax brackets are like the glass getting narrower as it fills. The same amount of water raises the level a little less each time. Annoying, but predictable, and you can still see the water rising. Benefit cliffs are different. They're like a hole appearing at the bottom of the glass the moment you cross a certain fill line. You pour more water in, and instead of the level rising, it drains out just as fast, sometimes faster. That's the trap. It's not that working harder stops paying off in general. Over a long career, it clearly does. It's that in this specific income zone, A single raise or a handful of extra shifts can land you exactly on one of these invisible drain lines where the math briefly, viciously works against you. And it disproportionately hits the people who can least afford the surprise: working parents, hourly employees picking up overtime, and anyone using income-based assistance to keep their household stable while they climb. So, what do you actually do with this? First, before accepting a raise, a promotion, or extra hours near these thresholds, run the real numbers, not just the new salary. Free online calculators exist specifically for this, built by benefits navigation nonprofits that show your full effective income after subsidies and taxes, not just your gross pay. 5 minutes with one of these tools can show you exactly where the cliffs sit for your state and household size. Second, know that raises aren't the only lever. If a raise pushes you right up against a cliff, ask whether part of the increase can come as a pre-tax retirement contribution instead of straight salary. Contributing more to a 401k or HSA can lower your taxable income enough to stay under a subsidy threshold while still increasing your total compensation. The money still lands in your life, just on a different side of the ledger. Third, if you're on an income-based student loan plan or receiving subsidies, request a recalculation timeline from your provider before your raise takes effect, not after. Several programs allow you to time when a new income gets reported, which can buy you months of runway before a payment adjustment hits. Fourth, and most important, understand that these thresholds are not evenly spaced. They cluster in that specific middle income range. Once a household clears roughly $75,000 to $80,000 combined income, most of these cliffs are behind them, and every additional dollar starts behaving the way people assume income always behaves, mostly theirs to keep. The trap isn't permanent. It's a specific survivable zone, and knowing exactly where it sits is the entire advantage. This was never really a story about one woman's raise. It's a story about a system built one program at a time by people who never sat in the same room, each one drawing a line without knowing 4 other lines already existed nearby. The lesson isn't don't take the raise. The lesson is that income and wealth aren't the same thing, and the relationship between them isn't always a straight line, especially in that narrow, dangerous middle zone where good news on paper can quietly become bad news in your bank account. The people who navigate this successfully aren't the ones who earn the most. They're the ones who understood, before they said yes, exactly what a bigger number was going to cost them. But benefit cliffs are just one of the invisible systems working